Hi, it's Charles Baker, real estate appraiser based in Pasadena, California, and I want to welcome you to part two of my seminar, Appraising Fire Damaged and Destroyed Residential Properties. So, part two, we're going to cover federal disaster declarations. What are they? What do they include? We'll talk about various types of insurance coverage. We'll talk about the California FAIR Plan, conducting pre-fire insurance appraisals, and a proper scope of work as we go about doing this work. So, federal disaster declaration. What does it mean? It's issued by the president and it designates areas affected by natural disasters, such as hurricanes, wildfires, floods, that sort of thing. Also, earthquakes. And it designates these areas as eligible for federal assistance, including grants, loans, and tax relief. Now, for casualty loss purposes for the IRS, they define it as a sudden, unexpected, or unusual loss of property due to events like natural disasters, theft, or accidents. And these losses are deductible on tax returns if not fully covered by insurance, with special rules for federally declared disaster areas. So taxpayers may deduct casualty and theft losses relating to their home, household items, and vehicles. And they can do this on their federal income tax return if the loss is covered by a federally declared disaster. Amounts reimbursed by insurance are not deductible. In the event of a federally declared disaster, various forms of relief are available, and they include FEMA assistance, which are grants for temporary housing, home repairs, medical expenses, and personal property losses. SBA disaster loans, and these are low interest loans for homeowners, renters, and businesses to repair or replace damaged property. Tax relief, and these are extensions for tax filing and payments. The ability to deduct casualty losses without standard limitations and potential refunds for prior year's tax adjustments. And what we know now is that the federal tax deadline has been extended to October 15th in the affected counties. Unemployment assistance, disaster unemployment assistance for individuals who lose jobs due to the disaster, but don't qualify for regular unemployment benefits. Food and nutrition assistance. So emergency food benefits through the Disaster Supplemental Nutrition Assistance Program, or DSNAP. Housing assistance. And this includes rental assistance, home replacement, and transitional sheltering programs. Public assistance for communities, and these include funds for infrastructure repair, debris removal, and emergency protective measures. These benefits vary by disaster and are coordinated through FEMA, the SBA, the IRS, and other federal and state agencies. So we're going to talk about insurance issues, specifically some examples of insurance coverage. What are they? We'll talk about admitted versus not admitted carriers and what's the difference there. Private insurance versus California FAIR Plan, what the coverages are for each. DIC policies, which stands for differences in coverage policies. And then insurable value versus replacement cost. I found this chart interesting. This is from the Joint Center for Housing Studies of Harvard University. Rising home prices and homeowners insurance costs are dual affordability stressors. Yeah, no kidding. From the Great Recession to the present, homeowners insurance prices have increased 74%, while home prices have increased more than 40%, even after adjusting for inflation. Real premiums have risen approximately 20% between 2020 and 2023 alone. This is a real affordability stressor. According to the Insurance Information Institute, the 5 U.S. states cited here have the highest number of residential policies in fair access to insurance requirements, or FAIR plans, in the United States. The right axis scale reflects the estimated aggregate value of all insurance in all FAIR plans in all lines, except liability and crime in 2024. And this is in US dollars using US Bureau of Labor Statistics Consumer Price Index inflation calculators. Now, Florida tops the list here with 1.2 trillion in exposure, and that's followed by California with 313 billion. So let's look at typical insurance policy coverage. Standard coverage components are divided into several categories. Number one, dwelling coverage, or coverage A. This protects the main structure of your house and typically covers damage from fire and smoke, wind and hail, lightning, vandalism, falling objects, weight of ice and snow, among other things. And it's usually recommended to insure for 100% of replacement or rebuilding cost. Now, in California, it's important to note that earthquake damage is not included. Now, in this case, the home is 2,246 square feet. Coverage A, which includes extended replacement cost, equates to $380.12 per square foot. In this case, the garage is attached. So coverage A includes the garage. Now, coverage B is for other structures, detached structures like garages, sheds, fences, pool houses, ADUs, that sort of thing. And when I was working the Malibu fires, there were a lot of detached structures. Includes, barns, equestrian facilities. And that coverage is typically 10% of dwelling coverage. Now, in California, natural disaster coverage standard policies do not include earthquakes or floods or landslides or mud flows. So there are separate riders for those. Now, fire coverage. It's mandatory for insurers to cover fire damage in California. It's very important in high-risk wildfire areas, of course. It may require additional brush clearance and safety measures. California Fair Plan is available if traditional coverage is denied. Now, up in Lake Arrowhead, we have a cabin up there, and we have a California Fair Plan for fire, and we have a DIC policy for basically everything else, and we'll talk about that. Common exclusions related to earth movement, as I said, water damage from flooding, sewer backup, ground seepage, and the like. It also it excludes neglect or poor maintenance, intentional loss, war or nuclear hazards, government actions, required coverage features. They must include extended replacement cost options, building code upgrade coverage, debris removal, and fire department service charges. Those are required. Let's talk about admitted carriers versus non-admitted carriers. So admitted carriers are companies like State Farm, Farmers, Allstate, many others. Non-admitted carriers would be Lloyd's of London, Lexington, and many others as well. So non-admitted carriers are best for high-risk properties, unique coverage needs, excess and surplus lines, specialty coverage, coverage in catastrophic prone areas, and hard-to-place risks. So the FAIR Plan is a pool of insurers required by law to provide fire insurance to property owners who can't find insurance elsewhere. Its customer base has grown dramatically in the past several years as insurance companies have increasingly refused to write or renew policies in the state. Well, citing increased risk of wildfires, and it is now more than 451,000 policies. So FAIR Plan offers basic coverage, and which typically includes dwelling insurance, and may offer limited personal property and liability protection. risk acceptance. Properties that might be uninsurable under conventional policies due to location, construction type, or claims history may still obtain coverage via the FAIR plan. And as far as availability goes, it's often the only option for properties in very high risk areas, making it a critical component of California's property insurance landscape. So DIC, difference in coverage plans. What are those? Well, they fill in the coverage gaps, often used to cover losses from disasters or conditions that fall outside the standard policy's scope. This can include events like severe weather or events that cause widespread damage, and they can be customized or tailored to the unique risks of a property or a region, which, can vary significantly from one area to another. In some cases, they address a loss of use, debris removal, or even environmental hazards. So what are the limitations of DIC policies? Well, they're not standalone replacement policies. They come into play when standard policies leave off. As such, they must be coordinated with primary coverages. Now, exclusions and triggers. The triggers for a DIC policy can be more stringent or narrowly defined compared to standard policies. So careful review is necessary to understand what events will cause the policy to pay out. And a little bit of FAIR Plan news. Well, the California FAIR Plan is slated to impose a special charge of $1 billion on insurance companies. This is the first such move in 3 decades. It's kind of like an assessment in a homeowners association. And the last time was in 1993 after the Kinaloa fire in Altadena and the old Topanga Canyon fire. This is a comparison of the California FAIR Plan in the upper left corner versus DIC coverage limits in the lower right-hand corner. FAIR Plan is essentially fire or lightning, smoke, and internal explosion. For contents, fire and lightning, smoke, and internal explosion. It's very little coverage outside of those 3 events. For DIC coverage, I've got showing on the lower right-hand corner, coverage A for the dwelling, other structures, personal property, loss of use, personal liability, medical payments, and all other perils. So it's important if you have a FAIR Plan policy to also have a DIC policy to cover everything else. So let's talk a little bit about insurable value versus replacement cost. In summary, insurable value is a subset of the replacement cost, tailored to what the insurance policy will cover. Insurable value is usually considered to be the replacement or reproduction cost plus allowances for debris removal or demolition and non-insurable items. Sometimes cash value or market value, but often it's entirely a cost concept, according to Marshall and Swift. And this definition came from the Dictionary of Real Estate Appraisal. Deductions from the cost approach are typical for insurable value, and these are called exclusions for foundations, underground piping, architect's fees, and so on. Now, inclusions would be things such as appliances, electronics. So, as an appraiser, it's crucial to clarify these distinctions when working with property owners, insurers, or other stakeholders to ensure accurate valuations and appropriate coverage. Okay, let's talk a little bit about pre-fire insurance appraisals. We'll get into the scope of work, sources of data, conducting a site inspection, determining what was lost, and valuation approaches. Now, some of these will be in part 3 of this presentation. The dilemma here is often not knowing having a clear picture of what was lost. Evidence is oftentimes very spotty, it's dated, or it's just non-existent. Public records, such as assessor's data, permit records, may be inaccurate. So when you are doing an insurance appraisal of a property that no longer exists, what would be some of the documents that would be helpful? Well, I was asked for past appraisal reports, drawings, old photos, videos, any permits that they may have, or just notes, anything that we can have to conduct a forensic analysis of what was lost. Let's get into this here a little bit. The scope of work for insurance appraisals. It's very important to keep this in mind. Pre-appraisal preparation. So, number one, client engagement. You want to meet with the property owner or the insurer to understand policy requirements, coverage limits, and any specific areas of concern. Document review. This is where you compile and review relevant documents, including previous appraisal reports, construction plans, repair records, old photos, and insurance policy details. Property research. This is where you perform preliminary research on the property location, neighborhood, market conditions, and local building codes to understand contextual factors affecting replacement costs. Now, when you're at the property conducting your property inspection, these are some important things to keep in mind. Obviously, we're going to do a visual examination, and this is where we conduct a thorough on-site inspection of the property, which includes the exterior structure or what's left of it, foundation, landscaping, if any of it still remains. If not, what we want to do is walk the grounds, take note of the views, the access, topography, and try to get a sense if that foundation is usable. Any additional structures or improvements. We're going to look at garages, sheds, pools, guest houses, and that sort of thing. Next, we want to do all of our photographic documentation, compare comprehensive photographs, capture comprehensive photographs, and if needed, record measurements and sketches of key features. Next involves the cost analysis, and this is where we itemized our cost estimation. We develop an itemized cost breakdown of the repair or replacement costs using up-to-date material and labor rates, which includes structural components such as the foundation, walls, roof, non-structural components such as lighting, appliances, and finishes, and then specialty items such as security systems, smart home integrations, lighting, computerized, this, that, and the other thing. Conducting local market adjustments. We need to factor in local market conditions, including labor cost variations and regional material pricing. Comparison evaluation methods. This is where we evaluate replacement cost and insurable value approaches to determine the most appropriate method for the appraisal context. Report preparation. And this is where we compile our findings. We summarize all inspection notes, photographic evidence, and cost estimates. We clearly document the assumptions, the methodologies, and sources used. Do we invoke a hypothetical condition or an extraordinary assumption, or both, or neither? Well, in the case of insurance appraisals, where we're conducting pre-fire valuations, obviously it's not a hypothetical condition because we know the house was there prior to the fire. We may invoke an extraordinary assumption if we are grappling with the forensic process, if we don't know for sure what was there. But, if we have an appraisal, if the house was just completed and we have plans and specs and construction cost estimates, then an extraordinary assumption is probably not necessary. Okay, then we do a detailed report writing of a draft, and that's going to include an executive summary of findings and conclusions, a detailed description of property characteristics, a comprehensive cost breakdown for rebuilding or repair, and any necessary disclaimers regarding the limitations of the appraisal. Finally, we review, do quality assurance, make sure that the report meets all industry standards and regulatory requirements, and perform a quality assurance before delivery. Finally, we present the report to the client, explaining all the aspects of the findings and responding to any questions regarding the methodology or conclusions. Now, there's always going to be some post-delivery communication that takes place with the client. In this case, it might be an insurance adjuster, an insurance company, and we want to advise the client on potential insurance policy adjustments based upon subsequent findings. Or maybe there's increased coverage or endorsements were added to the policy. I remember in one case in Malibu, some information came in after I had conducted my analysis and reported my findings. And so I was able to revise my report accordingly. And finally, gather client feedback and provide any required revisions or requests or supplemental documentation within the agreed timeline. This is very critical because insurance companies and adjusters are dealing with people who have been displaced and have lost everything. So it's up to us to really, really step up here. So this concludes part 2. Now, part 3 is going to cover we're going to talk about report examples, valuation approaches, data sources, litigation, post-fire stigma, and then we'll do a wrap-up and final thoughts. So I appreciate you being here for part 2, and I hope to see you on part 3.